It's a pleasure to be joined today by Toby Lewis, CEO of Novum Insights. Toby, thank you so much for joining us.
Hi, Teana. It's great to be here as well. So thanks for having me here at Coinscrum.
Absolutely. It's a pleasure. So we're going to take a look at some of the research you've been doing on crypto funds and hedge funds. But before we start, for those in our audience that might not appreciate the nuance between the two of them, can you just clarify the difference in what you classify as a crypto fund and a crypto hedge fund?
Yeah, so I think the essentially our data has been looking at the sort of wider crypto fund universe. So anyone trading or doing particular forms of investment in crypto funds. A hedge fund specifically, you're typically talking about a group that's doing investments where there's some form of hedge, literally. So where they're looking to try investments on both sides, and so that's essentially the difference. So in some ways they're often used interchangeably by people in the industry, but I think the better terminology is crypto funds, because a lot of groups aren't really doing hedging. They're maybe doing some form of alternative strategy, although there are some that are doing it. So it's more, and a lot of the crypto funds are actually characterized by almost quasi venture capital style strategies. So if you look at the likes of Polychain or Digital Currency Group or Pantera, they are deploying some hedging strategies, but some of the stuff that they're doing is just simply buying new issues. But each group has various different forms of strategies to get their returns.
Okay, so let's dig into some of the data a little bit. What have you found with regard to crypto hedge funds? How many of them are there out there? And what's their geographic distribution?
So there's roughly 300 hedge funds and sort of crypto funds, and half of those are more or less in the US, which is kind of unsurprising in terms of the capital market. Although there is a tricky regulatory environment for those groups to be operating in the US as well. You can see the great sort of geographical spread that goes all across the world, really. And I think obviously, I think the returns have been very intriguing. The 2018 market was quite a tricky market for the crypto fund market. The quantitative funds ended up slightly up on average in that year. That's PwC data. But then the most funds took significant losses in 2018, but then they rallied back hard in 2019, and I think a lot of groups are finding best practices. I'd say crypto funds are kind of like fireflies at the moment. Their lifespan can be pretty short sometimes. I mean, I've seen many super smart groups come and go over the years, so their life sizes can be 2-3 years. But I think what we're seeing now is the building blocks of groups with bigger assets under management that have stayed the course through various cycles.
Okay, so how are these funds broadly participating in the market across the different assets?
Yeah, so perhaps unsurprisingly, BTC is the biggest market, and then sort of it goes down across your. I think the funds generally are looking for institutional appeal, so often trying to allocate heavily towards the major traded cryptos, the ones with liquidity, the ones that they won't get into because they're needing to put together legal prospectuses and these kind of things. If they are going after more exotic cryptos, they will need to be relatively clear and have a small basket. So they can go fairly far and wide, but the portfolios that you can, and you'll see the graph there, but like it'll be the larger cryptos, the BTCs, the ETH, the variants on BTC, the and dipping in and out of particular assets that are most likely to have liquidity.
Okay. And across all the funds that you've researched, how many of them are using third-party research? So
it's a small percentage at the moment are using third-party research, and I expect that to change. It's roughly in the sort of 25% range, and I think that is indicative of a fairly immature industry at the moment, which I think will, if you look at institutional markets, those sort of players absolutely subsist and thrive on it. I think that there is, like, there are certain techniques that hedge funds and crypto funds in this market are finding, and they can be very tech driven, so they might not feel they need research, but I anticipate, like, if you look at the sort of voracious consumption of research in the traditional markets, that will only go up and up.
Yeah, indeed. And I think we've always had kind of a lack of reliable data. And that's starting to improve. So, you know, that may be an indication as well that when the data becomes more statistically relevant, then there would be more appetite to then consume said data. What about fees? What do the fee structures typically look like, and how do they compare with traditional funds?
Yeah, well, they're actually, because it's an alternative asset class, hedge funds, crypto funds in the space are able to charge much more than in traditional markets. So the old phrase of a hedge fund was 2 and 20, right? An alternative manager would want to charge a fee of 2% with 20% carry. So annual fees of 2% of the asset managed and 20% of the gains they made. The crypto funds are typically able to charge a bit above that as an average, right? If you think of that over the industry, there are some that are able to charge, and this was especially the case in 2018, 2019, people were charging 3 and 30, even more, right? So it was because they were getting pretty eye-popping returns in the boom years and getting access in 2017, 2018. And these are difficult markets to trade. They're very complex. So I think there's still a bit of an edge for the managers that are able to demonstrate strong performance in terms of the fees they're able to argue for.
Fantastic. Toby, thanks so much for joining us today and breaking this research down for us.